Over the past 100 days, the S&P 500 has returned a staggering 27%. This is something that hasn't happened since the initial stages of the COVID-19 rally. In fact, this type of rally over a 100-day period has only occurred 6 times over the last 25 years. And what's the most surprising is that these types of rallies often signal that there was more strength to come in the months or years that followed. But as we see what looks like the beginning of a brand new bull market, the question at the back of everyone's minds is how the rally can possibly continue when the stock market is the most expensive it's been since 1999. The Buffett indicator, for instance, is at its highest level since 1947. This is a model that was proposed by Warren Buffett to easily evaluate how expensive the market is because it adjusts the price of the S&P 500 for GDP, which is the size of the economy, essentially giving you how US stocks are priced relative to the size of the US economy. And today that ratio is coming back to the levels we witnessed at the top of the market in late 2021, but it doesn't seem to be showing signs of stopping. Some argue that the stock market doesn't care about the economy anymore, and that something called liquidity is going to keep on making the market rise. And indeed, since 2009, following the financial crisis, we've seen the money supply in the United States steadily rise, and even more aggressively in 2020 during the pandemic. And this liquidity since 2009 has been incredibly correlated with what the S&P 500 is doing. Today looks like the S&P 500 is just front-running the resumption higher of liquidity that's going to come from the Federal Reserve lowering interest rates. Back in early 2022, the stock market front-ran the fact that the money supply was going to contract. Right here is the moment when the Federal Reserve began to raise interest rates and do something called quantitative tightening that brought the money supply down. But since October of 2023, they've been very clear that all of that is going to be reversed, which is fueling this massive move up in the market. Now, what's interesting is that when we look at the S&P 500 divided by the money supply, we get a chart that looks like this. Since about 1960, we've seen the S&P 500 go up at about the same pace as the United States money supply. In fact, between 1960 and the peak of the market in 2021 right here, the money supply and the S&P 500 grew at the exact same pace. Recently, however, we've seen this chart break out above this resistance line that marked the top in 2007, in March of 2020, and the top in January of 2022. In 2024, we've now seen the S&P 500 go up into a zone that has only been seen once in history in the late 1990s, a 3-year period where the stock market experienced incredible gains across the board, with many parts of the market going on a full-blown melt-ups. Yes, you did see brief pullbacks during this period, but ultimately the market strength continued until 1999, which was followed by an incredibly difficult period to be invested in the market. Now, the question we should be asking is whether this breakout that we're seeing right now is confirmation that we've just entered a melt-up type of environment like in the late 1990s. Because if that's the case, in the near term, this chart could go all the way up to the same level where it went in 1999, which would imply another 20% rise on the S&P 500 and would likely be followed by a very large peak. When we look at something called credit spreads, they've reached levels that we haven't seen since November of 2021. Now, credit spreads are basically how much risk financial markets are pricing in. When it's very low, it means financial markets are very complacent about the future of the economy. That was the case, for example, in the late 1990s. It was the case in 2007 and in late 2021. The higher it is, the more concerned financial markets are about the future of the economy. And today, credit spreads are incredibly low, almost reaching levels that we haven't seen since May of 2007, just a few months before the stock market peaked in October of 2007. But as you can see, these credit spreads can stay low for extended periods of time. That was the case for multiple months in 2021. That was the case for multiple years between 2005 and 2007, and for almost 2 years between 1997 and 1999. The way we use credit spreads in our trading is not just to say that they are low and so we should be selling the market. It's when credit spreads begin to rise from very low levels that you should start to be cautious. In May of 2007, credit spreads began to rise, but the stock market didn't peak until October of 2007. You also saw credit spreads rise well in advance of the bear market in the late 1990s. That's not the case today. Credit spreads are not rising today, telling us that we should be expecting a big top in the market imminently. They're just telling us that there's a lot of complacency in the market, which are the perfect conditions for that type of major market melt-up to occur. You've got the Federal Reserve that is projected to begin cutting interest rates in 2024 despite the economy not being in a recession. When we look at what the stock market usually does in these types of environments, where the Federal Reserve is cutting interest rates without the economy being in a recession, you can see I've highlighted all of those periods right here. In all the cases where the Federal Reserve is pausing or lowering interest rates without the economy being in a recession, the stock market tends to do really well. Of course, when a recession does come, it tends to drag the stock market lower, but right now that's not the case. The Fed is projected to cut interest rates without the stock market pricing in a recession. And on top of this, we have the artificial intelligence narrative that is accelerating this rally. The biggest beneficiaries of AI is large cap technology stocks. Microsoft, Google, Amazon. These companies have by far invested the most in AI startups in 2023, and these companies also happen to dominate over 50% of the global cloud market, which has the consumers and the data for AI to operate. As the AI Now Institute puts it, there is no AI without big tech. Together with NVIDIA, these companies that are exposed to the AI narrative make up 20% of the S&P 500. So investors that are rushing in the AI euphoria, expecting it to completely transform the economy, are pushing at least 20% of the S&P 500 aggressively higher. So the stars seem to be aligned here for the market to experience this breakout in what we can call the melt-up zone. If this chart touches the same level it reached in 1999, that would take the S&P 500 up to around 6,500 points. An economic recession in the United States seems to be the only thing that could stop this from happening. You can see from these gray bars here, pretty much all of the economic recessions that we've seen in the United States has resulted in this ratio moving lower. We don't think a recession is coming until the second half of 2024. In the meantime, the S&P 500 rally could very well continue. If the S&P 500 reaches 6,500 points, that would mean PE ratios climb from around 21 to 23, which is where they were hovering at throughout 2020, and in late 1999 and early 2000, they were also hovering between 23 and 24. So in the context of an AI euphoria, lower interest rates, no recession, this scenario doesn't seem that far stretched. In the short term, however, the stock market has not tested its 50-day moving average in over 137 days. That's the longest streak the S&P 500 has gone without touching its 50-day moving average since the massive stock market rally that we saw in 2020, where the S&P 500 didn't touch its 50-day moving average for 138 days. So we are looking for the S&P to at least revisit this 50-day moving average. Even during strong bull markets, the S&P 500 tags its 50-day moving average on multiple occasions. If we do see price come back to the 50-day moving average, investors who have been waiting for an opportunity to enter the market over the last 137 days may finally get their chance to do so, rushing into the S&P 500 and pushing it for one leg higher.